Lisa said it, yields up, stocks down. Live from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, we begin with the big issue. It's Jobs Day in America.
The jobs report.
The U.S. labor market data.
We still have a very strong labor market.
It's going to keep the Fed very much on their mission.
We're in this period where every miss or hit or every economic information becomes so important.
The Fed has been very explicit.
Until we see concrete signs of inflation peaking.
Until we see a change in what's happening in the labor market.
They are going to be tone deaf to slowing in the economy.
Participation is really the key to the Fed being able to pull off that soft landing.
The participation rate has been so critical.
It's a huge element.
They are talking very tough. They're sticking to a script.
They're going to want the data to tell them to start to cut.
There's nothing in this report that is going to suggest to them that they need to pull back.
Let's get that data with the numbers. Here's Mike McKee. Morning, Mike.
Morning, John. Slightly stronger than expected. 263,000 jobs added to the payrolls in the month of September. The August number of 315,000 was unrevised. The unemployment rate, though, falls to 3.5% as the participation rate drops a bit. 52,000 people dropped out of the labor force. Last month, we'd had 768,000 additional people in the labor force, and that's why unemployment goes down. Average hourly earnings come in bang on expectations, 0.3 for the month, and a 5.2% for the year, or 5.0% for the year, which is a little bit of progress for the Fed. In terms of the jobless story, black and Hispanic unemployment, 5.8% and 3.8%, both of those drop from the prior month. The U6 drops to 6.7%, and as I mentioned, 57,000 people fewer in the labor force, while employment went up and unemployment went down in the household survey. There are some interesting changes. We would have had an even more stronger report if we'd spread the number of teachers and education workers over August and September, because more went into August than in September. Seasonals pushed down the overall numbers for education. But service providing, look at that, 244,000. Of those service jobs, retailers were gained just 1,100, and professional services was the big winner, 46,000. Do companies, are they hiring at this point on the temporary side because they're not sure where the economy is going? Real estate was the last number I had on there, 5,000 jobs gained. That was the number, the sector that was supposedly collapsed during the month. So it's kind of hard to know what happened there. Bottom line, participation rate falls, and that makes the unemployment rate go down. More people hired than lost jobs, but participation is the key to the unemployment rate this time.
With that in mind, Mike, do we have to put our soft landing supply side dreams on hold?
No, I mean, you've still got a soft landing in these numbers because you've got a fairly strong payrolls report. 263,000 is above the 191,000, which was the average for the 5 years before the pandemic. So still a strong report. 3.5% ties for the lowest that we've had. So at this point, it still looks good in the labor market. And with average hourly earnings going down, the Fed is on track, at least, to get to where it wants to be.
Mike McKee, thank you. How much pain, how much damage will they need to cause to get there? Futures down by 1.25% on the S&P. The conclusion for many is this Fed has more work to do. Yields up at the front end by 4 or 5 basis points on a 2-year, 4.30. On a 10-year, 3.88. Yields up around about 6 basis points. Pleased to say, Rick Reeder joins us now from BlackRock. Rick, wonderful to catch up with you again, buddy. Let's start here. Your response to that jobs report?
It's solid. I mean, I think the commentary, I think what Michael said is right. I mean, it's solid. You know, to have these numbers, you know, this far in a cycle is still pretty impressive. That being said, I think you have to put a little bit of perspective on it. You know, the number, if you take the 3-month average, so we got 260,000 jobs-ish. The 3-month average is 375. The 6-month, I think, is 475. So deceleration, but it's still solid. I mean, you look at the job openings that we got this week. You know, you had job openings coming down. You look at the claims data up a little bit. So Listen, it's moving in the right direction. Today was solid, though. I mean, I think all the commentary about it's just, you've got an economy that is still operating at a pretty good level, and the Fed's got to keep going.
Spent the week saying bad news was good news. Is solid news bad news? Which one is it?
So I will say, by the way, it felt like another month this week. By the way, the discussion earlier this week that was surreal to me, Jonathan, around Fed pivot, Bank of England does something because the pension system is having a challenge, that maybe this is a sign of a pivot or put by the central banks. I thought that was bizarre. There's no pivot. The Fed has got to keep going. And, today for markets, listen, softening of the data is something that we're going to want to see. By the way, when we get the CPI report next week, we're going to want to see some softening. If it's not, that puts you in a tough spot for the Fed, and financial conditions will continue to be under pressure. It doesn't give you come in every Monday morning. It doesn't give you like, let me get more financial assets on board when you're in that sort of environment.
Rick, I was listening to a podcast that you did with Meb Faber. Congratulations to you both, by the way. It was a fantastic listen for me over the weekend. And just listening to you both talk, just seems like, Rick, you've never been through a market like this before. You sound exhausted after this week. What a month the last week has been again. What are your thoughts on that?
So I would say there are two parts of it. One, it is the most exhausting. I mean, trying to parse all this data. And by the way, spend a lot of time looking at corporate earnings and what's happening. The margin pressure, is business spend going to slow? Because I think that's going to trigger. Is business spend going to start to come off? So, gosh, there's a lot you got to go through. I mean, I seem to get up a few minutes earlier and go to sleep a few minutes later every day. That being said, Jonathan, I mean, what you have to take some thought on or perspective on, this is if you're a fixed income investor, the next few years are going to be, I think, extraordinary. You're pricing yields to levels that we haven't seen. I know, I think on that podcast as well, like you can sit and wait in cash in short duration assets and get paid very well for it. This is creating an environment that, the markets have to recalibrate every few years. This is a massive recalibration. By the way, Jonathan, my partner, Bob Miller, reminded me this morning that in March, the funds rate was at 0 and the Fed was doing QE.
Yep.
And you think about now we've got our price and terminal funds rate, closer to 475. That's a lot of movement in a few months.
They've done 300 basis points in 6 months. I think it took them 3 years to do anything close to that in the last rate hiking cycle. Rick, you said a few years. And I just wonder, can we get to that new equilibrium with Fed funds in and around 4? Can we get there and stay there?
So listen, I mean, I think the Fed said you got to keep going. I think, there's something that's really important per my comment. You think about where we've gotten to, your point about how much they've raised the funds rate. And then, by the way, they're draining liquidity. If you think about since where we were in December, you've drained $1.3 trillion of liquidity. You've drained $300 billion in the last month. Rates higher, liquidity getting drained. By the way, this will have an impact. And so part of why I think the Fed's going to get to the number and then pause for a while. And I think you get a 75, you probably get another 50. We can debate another 25. You just did an immense amount. You've got to let the system, you've got to see what happens to business spending, what happens. You see these openings drop like a stone, job openings drop like a stone. So I think you got to see a little bit. When people say you got to keep going, listen, the Fed was easing too long. Now they're tightening historically aggressively. Think about it. If they go too far, then you got to start easing again. It's crazy. I think you've got to let the system recalibrate. Let's see, because this is historic amount of monetary tightening.
Rick, you've been in cash for a while. You've carried high levels of cash through much of this year. We've talked about it a fair bit. If they start to decelerate rate hikes from 75 to 50 to 25, is that sufficiently good news for you to say it's time to add a bit more capital?
So, Jonathan, in the next month, you think about what we're going to have happen. We got the CPI data coming out next week. We're going to hear more about the Party Congress. We're going to hear more about the war. We're going to hear more about UK utility prices. We got a lot of data coming in the next month or two. If the data, we've been getting a lot of bad news. If the data starts to suggest, economy in the U.S. moderating, we're getting through some of these exogenous shocks in a bit better way, or at least we know what the news is 30 days, 60 days hence, then yes, we'll start to put some money to work. And then you start to feel better about beta. Cash will rotate into equities as opposed to now. I just don't find it very exciting at all. We'll rotate a bit more in equities. You can now, instead of taking front end. Like I've been buying commercial paper. I bought commercial paper for 20 years, 15 years, 20 years. Gosh, now you can press more into the high yield market. Dollar stabilizes, maybe EM, but I still think you need 30 to 60 days. Let's see the data and let's see these developments. And then, if you get that deceleration and it looks like the Fed's going to pause, you could have a pretty good environment.
Rick, what do you make of how credit's priced at the moment in high yield? I look at spreads, and spreads don't scream recession. I look at price and yield, and maybe some of that is saying buy me. What do you see?
I'm closer to the latter. I mean, I think you're right. The spread's historically not that interesting, but you also have to consider the default rates are low, and companies have termed out their debt, and they're sitting on a lot of cash, and the structure of the high yield market is better because the energy market that created the duress a few years back is actually in better shape. So if you take the fact that the risk-free rate is now pricing at an attractive level, that you build that spread on top of it, and you can buy high yield at 8, 9, 10, depending on how much risk you want to take. I tend to like it. That being said, I would say our positioning is moderate because I still think you've got these things to work through. But listen, at the end of the day, if you said to me, would I rather book a 9 than worry about equity beta with margin compression and earnings flatlining to I think slowing? I'd like to take income into the portfolio. I think carry is pretty attractive. So I lean on the side of, by the way, I like it a lot more than real estate today.
Yeah.
When you ratchet the mortgage rate up. So I tend to like it, but listen, I think you got to be reserved in the size of your positioning today because of all the aforementioned.
Rick, the risk at the moment for many people, particularly over the last few weeks, has been in the risk-free asset. And one question I've asked a few times, and I'd love your response to it, if we're struggling to price the risk-free asset up 20 basis points, down 20 basis points on any given day on very little information, how do you price risk assets?
You can't. I mean, that's why liquidity in the markets, gentlemen, is so atrocious. It is. You can't. I mean, it's so hard. I mean, it's every financial asset we look at is the risk-free rate plus the risky rate, and if your most conservative part of that equation is bobbing all over the place, you can't. It's super hard. You've got to expand your bid ask, as it were, in terms of what's your entry point on an asset. And I think that's the way you're going to be for the time being. But let me. I just want to put this a bit in perspective. Sure. It is my favorite asset. Amazon, 2.25 years ago, when rates were at 0, issued a 3-year at 0.25%. We were funding Amazon at 25 basis points. It's now a 9-month bond that you can buy at I don't know the exact level today, but it's back at 4%. And so you think about that. Now I'm funding because of the risk-free rate. My real rate of return on the asset, pretty good. Particularly you look at inflation break-evens in and around 2. So it was a pretty interesting time to say, gosh, I need to expand my time horizon a little bit on assets that are yielding these sort of levels. And these are particularly if you can see in the front end. If you buy now a 3-year asset that's a 1-year or less, or a 9-month with a nice yield to it, that's pretty intriguing.
So, Rick, this gets me to the final question. You just talked about the change we've seen in Amazon in a few years. It feels like a few long years. We've just blown up a decade of negative rates, even negative rates in the corporate bond market, 0 rates at the Fed, QE, trillions of it. Rick, there are some people out there that just struggle to believe that we've fully realized the spillovers from that we can really go through the next couple of years without the default rate picking up a fair bit. What do you say back to them?
How much longer do we have?
You can have a couple of minutes.
I think it's really hard, Jonathan. I mean, listen. I don't think it's a given that you assume that, boy, now the thing has to break. Listen, I hope negative interest rates is finished for the rest of my career. I don't think it works. I think you create these anomalies in the system. I don't think it adds to velocity. It penalizes your pension system, your insurance system. It dulls investment. I don't believe in it. But what it did allow is it allowed companies to term their debt out. It did allow companies to get healthier. And so to say, we've got to see all of this unwind. Well, you're gonna slow an economy with a paradigm where you've actually got, by the way, not just companies, households. The household wealth and debt ratio is much better. The lowest part of the income strata is in a tougher spot. But generally, consumer leverage is okay, financial leverage is okay, and corporate leverage is okay. So, whether low rates allowed you to do all that, there is a fair argument to that. So, to say now it's going to unwind, it's going to create a problem, the system's in reasonable shape. By the way, the debt's on the government's balance sheet, which is not perfect, and will dull your fiscal expenditure, and certainly the cost of your fiscal expenditure. But listen, I think the starting point is reasonable, and to say, gosh, now the thing's going to tip over and it's going to get a lot worse, I don't see that. What creates stress in the system is leverage. I mean, in every time we go back to Asian crisis, et cetera. Now the leverage is not bad. It's on the government's balance sheet, which you can handle a bit better. By the way, some parts of the world that are dollar liabilities, not so much. Yeah. But you can generally handle it a bit better. So I'm not in the, gosh, this thing's going to be a disaster. I just don't buy that. And by the way, I don't think soft landing is an impossibility per what we're seeing play out today. But again, we got to see a lot of exogenous things, global dynamics play out over the next couple of months.
Hey, Rick, awesome to catch up. I know you don't rest much on the weekend, but get some rest. We've got to do it again Monday. Rick Reader there at BlackRock. Thank you, buddy, as always. Futures down about 1% on the S&P. Yields are higher. Coming up, the payrolls report. Keeping the Fed on track.
We just now need to stay the course. We said we're going to do this. We need to follow through and validate the expectations that we've set in markets.
Payrolls and politics, what the latest jobs data means for the Biden administration. That conversation up next with iCapital's Anastasia Amoroso and PGIM's Mike Collins.
I think we're quite a ways away from a pause.
Restoring price stability likely will require ongoing rate hikes.
Somewhere between 4 and 4.5% by the end of this year.
I anticipate additional rate hikes into early next year.
Headed for 4.5 to 4.75% by sometime next year.
And then hold at that level.
As we continue to move into more and more restrictive territory.
Can we achieve a soft landing?
Until we see inflation truly get close to 2%.
Stay the course.
We're all waiting for inflation to peak.
I'll be watching the data carefully.
That's going to be really critical for policymaking.
Stay the course. Fed officials sticking to the script and doubling down on their plans to tame inflation. The latest payrolls report giving the central bank a green light to keep going. This as the Biden administration faces a string of economic tests ahead of midterms with CPI, GDP and another rate hike still on deck. Bloomberg's Anne-Marie joins us now from D.C. Morning, Anne-Marie.
Good morning, John. Well, we're still waiting for a statement out from the president on what the White House actually thinks of the latest jobs report, but they're going to take this and likely say it is good news, especially that unemployment rate, 3.5%. Not only does it match a pre-pandemic low, but also comes in line and matches 5-decade lows. So they're going to say their economic strategy, as well as seeing above trend in wages, that it is working. But Jonathan, the issue is jobs, unemployment. This does not come up in the polls. The issue is inflation. So for this administration, what voters care about is next week's CPI.
AMH, thank you. I think next week's CPI is going to hijack pretty much everything. Anne-Marie down in Washington, D.C. Joining us now is iCapital's Anastasia Amoroso, PGIM's Mike Collins. Anastasia, wonderful to have you back. Your response to the jobs report 50 minutes ago.
Well, it came in right under the nose in line with expectations. But unfortunately, the challenge is this shows that the labor market is slowing, but is really not weakening. I would say there's broad-based strength. Most industries are still creating jobs. As Anne-Marie mentioned, the unemployment rate is at 3.5%, which aside from pre-pandemic, you have to go back to 1968 to see that. So it's still an exceptionally strong labor market. And herein lies the challenge for the Fed. I think they want to crack the labor market, and there's lots of room for them to do so. So, Jonathan, as we see the futures this morning, this is sort of really bad news for the market, because we kind of can see this train, wreck in motion, in slow motion, so to speak. We know that the labor market is going to continue to slow, and at the same time, the Fed is going to continue to hike. So between those two things, it's really tough for equities right now.
And Mike Collins, your thoughts on this? And I just want to throw in this quote from Ian Shepherdson of Pantheon Macroeconomics. He says the following, and on Twitter, "It's just hilarious that stocks are cratering after a statistically insignificant dip in unemployment and a statistically insignificant increase in the labor force combined to generate statistically insignificant falls in the unemployment rate and participation." Mike, I don't know if you got all that, but your response to it, please.
Yeah, I mean, this is good news for the economy, right? It's good news for those in the soft landing or the moderation camp. It's good news for people who want to hold on to jobs. It's good news for confidence, for consumer spending. But as we all know, it's all about the Fed. It's all about central banks, Jonathan. It's all about monetary policy, how tight it's going to get, and it's priced to get really tight, and the markets are reacting to that.
Anne-Marie said it. It's all about CPI. Next week is going to hijack the whole story. Anastasia, you know how this goes for November. If this Fed sets the stage to go from 75 to 50 to 25, Rick Reeder and I spoke about this moments ago. Is that sufficiently good enough for you to add to equity exposure?
No, Jonathan, I don't think so. I think it might be sufficient to create some sort of short-term bounce back. And that's what we've seen play out in the markets this year. But the reality is this is the Fed that is heading into restrictive territory. And the markets need to account for two factors. First of all, we're going to have depressed valuations. There's no reason for that multiple to expand. So that can't be the driver of equity returns when the Fed is clearly holding rates in restrictive territory. The other thing that's going to happen, we are already, this economy is sort of on the verge, on the brink, and as rates rise across the board, there's going to be more slowness and potential for a recession. So the markets will have to price that in, and that means the EPS downgrades are likely still to come. So even if we get some sort of a pop because of a so-called Fed pivot, the reality is the relative value of equities is quite challenged when rates are close to 4%.
Well, we're getting a drop now on the S&P. We're down by a little more than 1%. Yields are higher at the front end through much of this morning on a 2-year, on a 10-year off the back of that payrolls report. On twos are up 4 basis points to about 430. Anastasia, Mike Collins, going to stick with us, I'm pleased to say. Coming up in the morning calls and later, The View from the White House. We'll catch up with US Labour Secretary Marty Walsh responding to the Labour report. Looking forward to doing that with him in just a moment. That conversation just around the corner. Equities down, yields up, about 5 minutes away from the opening bell. Post payrolls, equities down a little more than 1%. Yields higher by 4 basis points on a 2-year, just south of 430. That's the price action. Here's your morning calls. First up, RBC downgrading lift to sector perform, slashing its price target nearly in half due to competitive and structural headwinds. Baird downgrading Norfolk Southern to neutral, highlighting potential downside given the weakening macro economy. And finally, KBW upgrading Goldman Sachs to outperform, expecting shares to move higher after earnings later this month. Coming up, it's the opening bell. Much more with Anastasia Amoroso and Mike Collins, plus a conversation with US Labour Secretary Marty Walsh. That conversation still ahead. Equity futures down by 42 on the S&P. We're negative a little more than 1 full percentage point. Yields higher through the curve on a 10-year, up 7 to about 389. Your opening bell up next. 25 seconds away from the opening bell this morning. Good morning. Up on the week through Thursday's close by a little more than 4% on the S&P. Futures coming back in this Friday morning. We're down by a little more than 1%. Post payrolls, the Nasdaq 100 is down about 1.7%. The Russell of small caps down by about 1. The winners this week, all about energy. The energy names on the S&P up around 15 percentage points. Switch to the board and get to the bond market. Yields look a little something like this, up 6 or 7 basis points, 388.95 on a 10-year. Yields up at the front end as well. In the commodity market, we add some more weight to this crude rally through Thursday, up around 12%, up another 1 percentage point this morning. 89.33 had a little look at 90 earlier in the session on WTI crude. Dollar strength out there, euro dollar negative 0.25%, 97.67 on euro dollar. What are we, about 25 seconds into this? Let's get you some movers. Here's Abby.
Given the solid jobs report, John, we, of course, have the familiar story, as you've been talking about all morning. Yields up, stocks down. So let's keep it macro. One of the big drags, of course, Apple down 2%. Yields higher, mean technologies down even more than other stocks. Valuation really comes into concern. J.P. Morgan Chase, the banks lower, even with yields higher. And as the yield curve inverts less, that would typically help out banks. But that's really not the case. One of the conundrums of this year. We do have a little bit of a bid for the energy sector. In fact, it's the only sector higher at this time, with oil up 1%, as you were just mentioning. And then, of course, there's AMD. They missed sales by $1 billion. There's this sign of a PC slump. This stock, John, is now down more than 50% this year. And, of course, Morgan Stanley is warning that it could, in fact, even get worse.
Abby, thank you. Picking up on the energy story, the outperformance of energy relative to information technology. Story of the session, story of the year as well. Energy up by about 0.4%. Information technology, that group on the S&P, down almost 2.4%. A strong labour report, a weak set of chipmaker results. Not a good recipe for big tech. Ed Ludlow has more. Hey, Ed.
Good morning, John. It's not pretty on the Philadelphia Semiconductor Index, down 3.4%, biggest drop in around 3 weeks. As Abby said, AMD prelim sales for the third quarter missing projections by $1 billion. We also had Samsung overnight as well. First profit drop since 2019. There's momentum in the bad news for this sector, and all we're getting is evidence that it's not just a slowdown in the PC market, but for memory chips as well. We could be facing a pretty protracted slowdown in that sector. Also, of course, the jobs numbers hitting big tech pretty hard, looking at the NASDAQ 100 down 2%, and some of the mega caps also feeling the pain. It's not just this idea that higher rates discount the present value of future profits. I think there is mixed opinion on the street about how big tech, including higher multiple chip names, fare in a recessionary environment. It's not just about whether they have strong cash flow, it's also about the sort of breadth and diversity of their business. New versus old Dow theory. I think I heard you talking to Taylor about this the other day. It's this idea that chips are the new transports, right? Everything uses chips. So if chips are suffering, that's kind of a leading indicator in the way that rail freight used to. But I'm keeping an eye on this space. The signs have been there for a little while, and it could be a pretty ugly session in the semiconductors.
Taylor's the only one that can talk about the Dow on the show.
I apologise.
Let the rules out. It's all right. It's all right.
I love being the favorite.
Taylor Riggs made those rules up herself. Taylor Riggs, let's talk about the winners this week. It's all about energy.
The favorite children always get a pass. I'll leave that alone, John. Take a look at where we are with the energy sector. And I think what's really interesting, we were speaking with Jonathan Golub over at Credit Suisse yesterday and saying that if you've tech to the downside and energy to the upside, that is sort of the downside and the upside risk around the volatility of this quarterly earnings season. You take those out and things actually look stable. But energy, of course, does present sort of that upside risk. When you think about the huge rebound in crude again, looking at $98 a barrel. A few days ago, ExxonMobil had climbed 4%. That was at a 5-week high. Chevron is near an all-time high. So the good news, at least for the energy companies, keep continuing to come as we think about day 2, day 3 reaction to the OPEC plus production cuts, of course, that are underway. Of course, this is a big weekly gain that we see here, some of the biggest weekly gains that we haven't seen since March. Again, seeing that follow through from crude prices back into the energy stocks as well, because there hasn't always been that one-for-one correlation as well. Let's talk about the energy companies, though, John, as we're thinking about sort of the earnings season that's coming underway. As you can see, things actually don't look horrible. You're not looking at some massive declines here, at least when we think about the volatility around these companies, maybe shaping up to be another decent report, at least on a relative basis to some of the other sectors.
Hey, Taylor, thank you. Earnings season just around the corner, 1 week away. JP Morgan, October 14th, 7 a.m. in the morning. Kelly Lyons joins us now for more. Hey, Kaylee.
Hey, John, I can't believe we're already here again. And I would just like to remind our audience what happened in the aftermath of JP Morgan kicking off earnings season last time around. And that was actually a pretty healthy rally. From mid-June until mid-August is when we saw that 17% gain in the S&P 500 before we started worrying again about the macro policy picture and everything started to deteriorate. But the message of last earnings season, by and large, was it could have been worse. It wasn't as bad as feared. The question is whether that is going to hold true this time around, because we have seen expectations deteriorating the closer we get to this season. Looking at the Citi Earnings Revision Index, we see that downgrades are outpacing upgrades for 17 weeks in a row. That is what we see here on this chart. And if you listen to some of the bears on the street, that has further to go. Mike Wilson of Morgan Stanley has been pounding the table about this for some time now. The idea that we have not yet seen the bulk of earnings revisions, that we're still too optimistic given the economic outlook and the margin pressure a lot of these companies could be facing. So buckle up, everyone. It's not just about the results, but about the guidance as well. And as I said, and you said, it begins with the banks next week. Only $1.8 trillion worth of market cap will be reporting next week. It's really October 24th. That's the big one when we get all the big tech players, the Alphabets and Apples of the world. $15.3 trillion of market cap will come that time around. And of course, for a lot of those big tech companies, other big multinationals as well, there is huge overseas exposure. And so FX headwinds going to be a big theme this quarter too, John.
Kelly, thank you. That's your setup for earnings season. Back with us, I'm pleased to say, Anastasia Amoroso, Mike Collins. Anastasia, this is your theme, and I think it's an important one. Just because we see strength in the labour market doesn't mean there's no weakness elsewhere.
No, there's plenty of weakness elsewhere, and there's a lot to pick up on here in the discussion that we just had about semiconductors and energy and banks. And for semiconductors in particular, I mean, a secular grower as this industry is, it is definitely not immune from cyclical headwinds. And I think the weakness in semis have started with the PC market, and we don't need as many laptops and computers as we did during the pandemic. But I think that weakness is going to spread to other places. And for sure, we're likely to see slower spending on hyperscaler CapEx, for example, and that's going to negatively impact potentially the semiconductor trade. And then eventually, I think the auto market weakness is likely to come to fruition too. So I just think semiconductors is a tough place right now, and it is really showcasing the slowdown that we see in the economy. So that's one thing I wanted to comment on. And then speaking of other places where we might see weakness is the banking sector. And full disclosure, I've liked this space for the soft landing scenario, but we have to kind of pivot away from the soft landing scenario given what the Fed is doing. And so one concern that I'll be watching for in this earnings season is what happens with delinquency rates, what happens with net charge-offs. Are there any red flags that the banks are already seeing now? And most importantly, are they going to be provisioning for it? So my sense is most banks are likely to take a cautious approach. And instead of being a tailwind, which was this release of loan loss reserves, it's going to become a headwind because the banks will want to prepare for not a soft landing, but eventually a recessionary scenario. So those are the red flags. And energy, John, is a trade that we've liked all year and continue to want to buy on the pullbacks. And that view certainly has not changed.
Let me just unpick the bank story. That's from the equity side. Mike Collins, I get the feeling you actually like it from the fixed income side of things. Mike, why is that?
Yeah, there are a lot of sectors we like on the fixed income side, Jonathan, because again, if you look at the underlying fundamentals in the debt markets from a credit risk perspective, yeah, default rate expectations are going up, earnings expectations are coming down, margins are getting compressed. But are we going to have a big increase in defaults? Are the big banks going to default on their debt? Unequivocally, no, right? And are they, providing really attractive yields? Absolutely, yes. So there's a lot of fundamental value across different sectors. You look at not only the banks, but Anastasia talked about the commodity space, the energy space, even the home builders, which are reporting pretty dire results recently in terms of cancellations. The auto companies are going through a cyclical weaker period, but fundamentally, they're actually in really good shape. So when the cyclical credit sectors are in good shape, that means default rates will not spike. That means high yield spreads where they are and investment grade spreads are probably close to fair value here.
Part of the problem here, Mike, is you guys. You won't buy that debt. They've underwritten some deals and they can't spin off that debt at the yields that they thought they could maybe 6 months ago, 12 months ago. Mike Collins, is it a buyer's market finally in fixed income?
On the rate side, it is, right? When that 10-year note gets close to 4%, where it's approaching today, I mean, the markets are pricing in, Jonathan, a funds rate of 4 5/8 by next summer. That's another 150 basis points of rate hikes and not a lot of cuts going out for 10 years. The funds rate that's priced in over the next 10 years is still close to 3.5, right? So I think it's a buy on the rate side. On the credit side, we are being a little more cautious. I think the credit markets are fair value. They're not cheap. I think there's a good probability they get cheaper, and we would be buying on that weakness.
Last time we caught up, last Payrolls Friday, I think you said buy the 20-year. You like the 20-year. And Mike, the 20-year yield has climbed since then by a decent 30 basis points or so. Why was it that maturity on the curve, Mike, that gets your interest?
I think the whole rate structure, basically twos and out are cheap right now. I mean, I think all these yields, Jonathan, are going to be 100 basis points lower in the next year or two. All right, that's a lot of capital appreciation on top of pretty high yields. The reason we like the 20-year is because it jumps out at you relative to the 10 and 30-year, and it's just as abnormally cheap security on the curve, and there's a lot of embedded alpha in that part of the curve.
So I imagine you're expecting a break of the positive correlation we've seen between risk and the bond market. Anastasia, are you looking for the same thing to develop? And I wonder from your perspective why that would develop.
Yeah, John, I think the fixed income markets are a lot more attractively priced than they were in the beginning of the year. And I would argue that they're more attractively priced than equities right now. I mean, I really kind of agree with Mike, for example, on the bank trade, is that while equities may not be the most interesting place to be in banks, if you look at what you can get in the fixed income part of it, I think it's absolutely spot on. And again, to pick up on the capital ratios and the kind of the resiliency of the banking sector, the capital ratios are double what they were during the financial crisis. So this is not a solvency sort of risk. So as the spreads widen out, you get much better opportunities in fixed income. And look, John, the big theme for me this year has been get paid while you wait out this volatility. It looks like we're going to be doing a lot more waiting. So if I can get a little bit of high yield in the portfolio, if I can pair that with municipal bonds, for example, that are screening really attractively right now for investors, I think that's where a lot of focus will lie.
What I hear from Mike is Mike's got a decent idea of the destination here, Mike, and I don't. You think we can be 100 basis points south of where we are within the next 12 months. Mike, does that mean you think we're going back to where we were a couple of years ago?
No, I think the zero, that zero lower bound Fed funds rate is probably out of the picture for a few more years. We've always thought the range on the funds rate, Jonathan, for the rest of our lives will probably be 0 to 3, and we're here. So maybe the right range is 0 to 4 or 0 to 4.5. Maybe it averages 2 over the next 10 years, the funds rate. But what's priced in, like I said, is something closer to 3.5 on average for 10 years. And I still think that's way too high over the long term. If you buy now and close your eyes or go to sleep for 3 years, I think you're going to have really big returns in fixed income.
Anastasia, what do you think we go back to? What does leadership look like? What's the destination in your mind? Where does this all land?
Yeah, I mean, we clearly need to work through the Fed restrictive policy stance. We need to work through the slowdown in the economy. But at the end of the day, I would still come back to some of his secular growth stories. And, they're not going to be the leadership for the next probably few months. And maybe it's a year if it takes that long to kind of work through this restrictive stance. But if you look back and if you take a step back, what are the stocks that outperform the market over a long term? The most important thing is earnings growth. And if I think about where that earnings growth is going to lie, I mean, maybe some of it is going to come from the S&P, but, it's 7 to 9% on average is what the earnings growth for the S&P should be. Can I potentially outperform by going back to parts of tech, by going back to parts of healthcare and biotech and sustainability type trades? I think yes. The caveat to that is the big, huge tailwind for some of these tech names over the last number of years has been the zero interest rate policy. The multiple expansion has been a huge driver of returns. So I don't expect to see those outsized returns in the future. But if these companies can grow at 20, 30% per year, I think all things equal over the long run, they should still outperform the market and lead it.
Anastasia Amoroso, Mike Collins, the two of you, just absolutely brilliant. To Anastasia's final point there, zero rates, what did everyone chase? Long duration assets, no investment into things like commodities, basic resources. We weren't digging holes in the ground. We weren't building refiners. What are we seeing play out right now? This is what Jeff Curry of Goldman had to say. Revenge of the old economy. Energy up. That's the one big winner this morning, up by about 0.6% on the S&P. The underlying commodity up by 1.7% on WTI, 89.96. Had a look twice now at $90 on WTI. Brent crude, 95.93, up by 1.6%. Some breaking news just moments ago. Abby's got that. Hey, Abby.
Hey, John. Yes, we do have breaking news. CVS is said to be in exclusive talks to acquire Cano Health. Now, Cano Health, of course, operates primary care facilities and supports medical practices. So if this were to happen, this would be a continuation of their expansion, their diversification from retail. CVS, as you can see, plunging down more than 7% on pace for its worst day since November. This deal is not a done deal, John. And of course, Cano Health is backed by billionaire Barry Sternlicht. There's no certainty because Humana has a right of first refusal should Cano find a buyer under an agreement they made back in 2019. But right now, CVS investors not liking that. That stock down 7%. Cano Health has been halted.
Abby, thank you. Coming up on this program, the Payrolls Report, keeping the pressure on the Fed.
It's going to keep the Fed on track for a 75 basis point move at the next meeting. They were hoping that they'd still see a little bit more uptick in labor force participation, but they didn't get that.
The White House reaction up next.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Uma Moriarty, Center Square Investment Management Senior Investment Strategy Analyst. This is Bloomberg.
Live from New York City, about 20 minutes into the session, equities shaping up as follows on the S&P 500. We're negative 1.8%, the Nasdaq down by 2.36%. The gains in the S&P 500 through today and much of this week, just one pocket of the market, all about energy. Crude higher, up 2% on WTI, $90.24 on Brent crude, $96 and around about 20 cents off the back of the Payrolls Report in America. Joining us now on Bloomberg TV and radio, I'm Jonathan Ferro. We're joined now by US Labour Secretary Marty Walsh. Secretary Walsh, fantastic to catch up with you, sir. A robust labour market report. Rick Reeder of BlackRock called it solid. Here's my question for you, sir. You more worried about people losing their jobs or getting down inflation?
I think we need to work on, we're worried about both, obviously. I don't want people to lose their job, but we need to continue to bring down the inflationary pressures that people have. Certainly what OPEC made a decision on this week to do was not helpful to us. The president was disappointed. We're disappointed as administration, but we need to continue to bring down those pressures. I mean, I think that, you know, I had a long conversation in my office today. I certainly don't want to see the unemployment number go up. I like to see people working.
That's what the Fed is forecasting. Some people say that's the objective. How are you preparing for the pain that they're forecasting? And what can we do on the supply side when it comes to things like immigration?
Well, on the unemployment, you know, we've been talking for the last 3 months about seeing those numbers go down. And in the year 2022, we've had about 440,000 jobs per month. We're still seeing people, 263,000 people going to work today. This month, I should say, last month, we're still seeing those numbers going on. So I think that that's something that is important, that we continue to put those gains. We still have job openings. People are still looking for work. Obviously, we'd like to see the participation rate a little higher. I mean, that number went down a little bit this month, I think 0.1%. So we have to see what's happening there.
Clearly, the employee over the last couple of years is getting some leverage it hasn't had for a few years, a number of years, maybe even decades over their employers. You brokered a deal with unions in the last few months with freight rail companies, the 12 unions. I understand 4 of them have ratified the deal, Marty. Secretary Walsh, are you worried about the other 8?
No, I'm not. I mean, they're out there explaining, when I say they, the union leadership now and the bargaining committees are out there explaining to the members what's in those contracts. It was a very painful negotiation, not what I had, but leading up to me. 2 years of negotiation with really no movement. And I think that there's explaining to do in these contracts. And I look at these contracts, they're good. They're a good contract. I mean, it's 24% over 5 years, healthcare freeze cap, work rules change. It was a good contract for the employer and employee as well. So hopefully we can get the rest of these ratified in the next 6 weeks.
In the Rose Garden, the president said this: because of this labor agreement, those rail workers will get better pay, a 24% wage increase over the next 5 years, improved working conditions, peace of mind around their healthcare by capping the cost that workers will have to pay. Have the port workers on the West Coast, Secretary Walsh, asked for the same conditions?
No, I mean, I don't know. I don't know what they're asking for wages and benefits, but certainly those are all the conversations that are generally on the table. A little different negotiation. The West Coast port negotiation is a very fluid conversation. That both sides are at the table. They're both having conversations. It's a longer process than I anticipated, but that's just historically the way they've operated. They kind of take one segment at a time. I stay in close contact with both the employer side in the unions on the West Coast port, and you know, both sides have expressed to me that they're still moving forward. There'll obviously be sticky issues that'll pop up every now and then, but nothing that's making me be concerned that I have to have a 20-hour meeting in my office about.
What would make you concerned? Because you've seemed pretty relaxed about that over the last few months and through much of the summer.
I mean, I think if I heard one side or the other side just kind of saying that they're not moving forward enough or quick enough, and there's really concern, I'd see in their voice or hear in their voice, so that expressed to me. You know, I've spent, before this negotiation started, I spent a lot of time out on the West Coast, both sitting down with the unions and sitting down with the employers. So in this case, I have a lot better relationship with the employers and the unions than I did in the rail. The rail was kind of all new to me. The union side, I knew who they were, but I really didn't know the leaders of the unions, and I certainly didn't know the rail companies because I wasn't familiar with them in my old job. But so having that relationship with both sides going in, it makes it a lot easier to navigate and try and help continue to move along.
Secretary Walsh, if my memory serves me correct, I think the last time we did this on the West Coast was maybe 2014, and you can correct me if I'm wrong, but I'm just wondering, in previous experience, did it take this long?
Yeah, it did. It took longer, actually, and that's why I was having a conversation the other day, and I asked how long. It actually took longer. I think 2014. I want to say 28. I think it might have been a lockout in 28, and there was a strike in 1972. I think it was. So it does take a long time because it's very complicated. They're doing the whole port, all of the West Coast negotiation, and every peer has a different set of rules and negotiations that they have to do as well. So it's a master contract, but then there's individual rules in each of the ports. So they're going through all this systematically.
Secretary Walsh, big month coming up. Looking forward to catching up with you. Our next conversation will be sandwiched in between, I think, a Federal Reserve decision and the midterm. Secretary Walsh, thank you. The Labour Secretary, Marty Walsh, there down in Washington, D.C. Equities down about 1.9% on the S&P, and the Nasdaq down by 2.5%. I'm pleased to say Mike McKee's dropped by the studio just for final thoughts as we look forward to next week. Mike, it doesn't matter what we say about today. This whole conversation gets hijacked by CPI next week, doesn't it?
It absolutely does. Although I think going into CPI, we've pretty much decided that the Fed's going to do 75 basis points on November 2nd. So that may not have a major impact either. The impact on the markets today is the idea that the unemployment rate went down, and so the Fed has a lot more work to do. It is a bit of a conundrum because the labor force shrank, but the real change was the number of people who lost jobs compared to got jobs. In the household survey, employment was 204,000 strong, unemployment down 261. So you've got almost a 500,000 jobs swing between the two things, and that's why unemployment is falling. The good news for the Fed, and maybe the markets are just kind of overlooking this, is that we are seeing participation drop, we're seeing unemployment drop, but we're also seeing average hourly earnings drop. They've sort of stabilized on a month-over-month basis, and that's brought them down on a year-over-year basis. And that would be good news for the Fed. And so maybe we should see things start to change in the markets.
It's good news, bad news. Mike, I've confused myself all week.
We're all confused.
We're all confused.
We're all confused.
Mike McKee, thank you. The Fed speakers say they're not confused, and maybe we should take them at their word, or perhaps not. Mike McKee's going to lead you through the inflation coverage through next week. Looking forward to that. Your trading diary shaping up as follows. New York Fed President John Williams kicking off today's Fed speak at the top of the hour with Kashgari and Bostic on deck. President Biden speaking on the economy at 1:35 Eastern Time. Looking ahead to next week, Evans and Brainerd on Monday, FOMC minutes on Wednesday, CPI and initial jobless claims on Thursday. Real yield back again this afternoon. We'll catch up with Gargi Chowdhury, Charles Schwab's, Kathy Jones and Krishna Mamani. Looking forward to that from New York. Thank you for choosing Bloomberg TV. This is Bloomberg.